Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are on my boat. Happy Sunday. And we're going to be running through the key traps that get a lot of property investors and people who get into property stuck. So bear with me while I sort myself out here. So starting off, the key traps when buying property. I see it time and time and time again. People getting caught up in the hype or getting conned into certain strategies that aren't necessarily for them, but working with, I guess, people that don't look to buy property in the best interest of the buyer, rather their business model and just doing a tick and flick sort of model. So stay tuned. There's a couple of scenarios we'll run through. If you are looking to build a sustainable portfolio, these are the key items that you want to try and avoid. So before we get into it, let's go through a few stats. So how many property investors are there in Australia? There's approximately 2.4 million, or 8.5% of Australian population have an investment property. And out of that 8.5% of Australian population, or out of that 2.4 million people, approximately 72% of investors hold one investment property. Approximately 19% hold two. Just under 6% hold three. 2% hold four. And less than 1% own five or six and more. So the main reason why, which we'll get to in the future slides, why most people who get into property investment get stuck at one or two is because of these traps, which we'll discuss today. Try to avoid them. If you want to build a sustainable portfolio of 10 plus properties, you'll need to avoid these key traps in order to join the 1% of property investors who actually build a sustainable portfolio and achieve financial freedom through the passive income through their portfolio. Because you need at least 5 or 6 to really make it worthwhile. Having 1 or 2 properties really isn't going to set you up and be able to replace your day job and serve you and your family a lifetime. You need to build a sustainable and substantial portfolio of at least, I'd say, 6 or 7, and ideally 10 plus will really set you and your family up. So number one key trap. Now, this may seem a bit controversial or counterintuitive, but buying the family home or the house of residence first will get you stuck. It'll be like an anchor on a boat holding you down. You have a big fat mortgage. You know, if you're buying a house for 1.5, 2, 3 million bucks, the interest payment to the bank is usually 3 times the amount you could actually rent the equivalent house for. So run your numbers. By the time you pay the interest holding costs to the bank, maintenance, upkeep, rates, insurance, strata if applicable, by the time you add it all up, that's non-tax deductible, it'll be 3 to 4 times more expensive, that holding cost, than if you were to rent an equivalent property in the same area. So run your numbers. I personally rent where I live and invest across multiple markets. So we will look to buy the family home, but not until we've built a sustainable and substantial property portfolio that can support the family home without being such a burden on our lifestyle. So gone are the days of how if you listen to your parents or baby boomers who bought the family home, traded up, maybe started with a unit, then renovated, flipped it into a terrace home or a house and did that a couple of times. That strategy, I guess you can still try to do that, but with Sydney and Melbourne, particularly these days, being a global city, competing with the likes of Hong Kong, Beijing, New York, LA, you're competing with the wealthiest people around the world, the highest talent around the world. So the local wage in Australia, being it mainly Sydney and Melbourne, will never keep up with the price of property. So you're better off investing in more affordable markets, building wealth, building a cash flow machine that can then serve you and your family a lifetime, and then down the track, if you want to then buy your family home, but delay gratification. It's the same concept with buying a car. You don't go out and try and buy a Ferrari as your first car. Same goes for property. You don't try and buy your dream place straight off the bat because it'll ultimately hold you back of what your full potential is. So run your numbers. Buying a family home is probably the main reason why most people get stuck. And further to that is I personally think it's higher risk because you're putting all your eggs into one basket, you're putting all your servicing, all your capital into one location, and you're backing that that location will perform. Rather, if you diversify across multiple markets with a higher yield, higher cash flow, you'll be at a position where you'll be more stable, less risk to the downside. Because when we go through the next downturn, such as a COVID or a GFC like event, which is probably going to come around the corner around 2027, unemployment will probably get to 10, 11, 12%. If you lose your job and there's higher interest rates and you can't hang on to the big fat loan, well, the bank will be selling it underneath you before you know it. So the risk is higher when you're putting all your capital into one location and really squeezing yourself, and then you end up really being a slave to the bank. And yeah, sure, you might have a fancy house, but really you're living a pretty average lifestyle because you're constantly having the mortgage repayments lapping above your chin. So that's the main one. Number one for traps to think about: buy your investment properties first, build a sustainable portfolio, then look to buy the family home down the track. Trap number two, blue chip. I mean, this strategy is, to me, people that push this type of stuff are no better than the classic Parramatta car salesman, you know, complete con artists. Who in their right mind would go out and, for instance, look at the property on the left, Bondi Beach, two-bedroom apartment selling for, nearly 1.9 million bucks in May 2024. I feel sorry for whoever bought that because the intrinsic value of that property is only about 4 to 500,000. That's how much it costs to build a unit of that type of finishes and quality. It's not super high end, so it's just, pretty stock standard brick veneer type of asset. Who would want to go and pay 3 times more than what it costs to replace with a yield of probably 1 or 2%? Again, you could rent that same property for a third of the cost of holding it. So when you get into these assets, and again on the right, Hamilton, that's up in Newcastle, house 1.7 million. That's, Newcastle is a large regional hub, but right on the water. This is like Hamilton in Newcastle is considered a blue chip area. And the people that push this stuff are pushing growth, but they don't tell you about the downfall of not having cash flow. Because sure, if they have this strategy and they have a business that they're getting the cash flow out of their business that can support the shortfall, then the bank will then allow them to keep borrowing more money so they can keep buying these types of assets. But for 99% of people out there will get stuck at one or two of these assets if they get themselves hooked into this stuff, because it's like running a business when building a portfolio. You need to make sure that it's neutral to positive geared so the bank can continue to lend you more money. If you took $1 million loan out and went and bought, or if you took a 1.8 or $1.7 million loan out and went and started a business to chicken shop, whatever, IT business, any business. And then after year one, you made a 30 to 50 grand loss. And then if you went back to the bank and you asked them to lend you more money because you wanted to expand your business and buy another shop front or buy a fleet of cars, the banks don't do it. Not until your business becomes profitable and then you can service more loans or more more debt. So that's why most people who get into this blue chip stuff get stuck at one or two, and then you never get to a stage of building a large sustainable portfolio because the bank is not going to lend you more money. It's a game of finance when you get into property investment. You need to make sure you're buying assets that allows the bank to keep lending you more money and keep growing and building and being sustainable for the long term. So steer clear of people that push this stuff because they're running different agendas. It's easy for them, they get the masses tricked into saying, oh yeah, it's blue chip and it's got growth and all this sort of stuff. Every property has capital growth. You need to balance both capital growth with cash flow. So minimum 5% gross yield, minimum, and ideally between 6 to 8, but never go out and hook yourself to something like this that has a yield of 1 to 2% because you'll get stuck. And then good luck trying to hang on to it when we go through the next land-driven downturn, because same again, if you lose your job, you've got high interest rates, you've got a heavily negative geared property, and you don't have a business to keep funding the shortfall, then the bank will be calling the loan back and selling it from underneath you. And then God forbid you didn't overpay, because if the market softens and you're in negative equity, well then this type of stuff can send you broke. That's the trap number 2. Trap number 3, and I mean, I've sort of, as we go along, the traps get even worse, but house and land packages, this is the third biggest trap, which is even more of a trap. So any buyer's agent out there pushing this stuff is getting paid by the developer to push their stock because they can't find enough buyers to keep buying it. So they're getting kickbacks from the developer. So they got their best interest with the developer pushing this stuff and not the actual buyer who's buying it. Again, look on the left-hand side, this is Edmondson Park, 1.4 million bucks for a house. I mean, you can buy a block of land for a couple of $100,000 and then throw a house up for 500. So that's probably 50, 60% higher than the actual intrinsic value of this stuff. So, and the other thing that they don't tell you about is when they release more of this stock on the market, it suppresses the prices out there. So people that buy this type of stuff that think it's a good investment, little do they know that developers are releasing more and more of this stuff onto the market, which provides more supply, and then there's not enough demand, and then they get themselves into this and hold it for 10 plus years without any real substantial growth. They pay a premium because developers dictate the price of this type of stock based off the cost of the land subdivision, the land holding cost, interest, development costs, tax, margin, sales fees, all goes into the end cost of the product and not actually what it's worth based off its market value. So you typically pay overs for house and land packages, and they try and spruik you and sell up to, oh, you're going to have all this great depreciation, all this sort of bullshit. Look, depreciation is great, but it's not a reason to invest. It's the cherry on the cake. Sure, if you can get a depreciation report done and you can claim, 15 20 grand a year for 40 years for some unrealized some not real costs. It's depreciating of your actual asset. Sure, you get a bit of a kickback, but I mean, it's not a reason to invest. The reason to invest is to build a sustainable cash flow machine from both the rental income and the growth that will allow you to supplement your day job, step away from the workforce, and not be tired for the rest of your life paying something like this off. So steer away from anyone that spruiks this stuff. Even worse, again, new and off the plan. I mean, you might as well go to the casino and put your money in on red or black playing roulette. This stuff can go either way. If you're lucky enough and you get into an asset off the plan, you hear the stories where some people make a bit of money where they sign up to a contract and it's built 3 years later and they end up on completion having it a lot worth a lot more than it is, but it can go the other way. And I've seen people get wiped out by stuff like this. And the risks are the developer or the builder doesn't even finish the project to start with, so there goes your money. Or if they do finish it, look what happened to Mascot Towers. People bought new and off the plan shit in Mascot. The builder built a building cheap. When the people went to when the construction job was or the high-rise building was completed, they went and loaded up the building with all their furniture and moved in. When the building was loaded up, it then had structural issues. So then they had to evacuate everyone in the middle of the night. This is 4 or 5 years ago now. And to this day, they haven't got their money back. The developer went broke. The people who own the properties can't rent it, can't live in it, can't do anything with it because the building's structurally defective. And they still owe million+ loan to the bank. So don't get yourself tied up in this sort of rubbish because that's one risk that the builder is going to not even build a quality asset on. But second to that, like the house and land packages, the developers dictate the price of their products and slowly release it stock to the market to keep the demand there so they can get the prices. So you typically pay overs. The intrinsic value of a new unit is 450, 500 grand to build. So if you're paying $1 million plus for a unit, then you're paying almost double what it's actually worth to replace it. Plus, if you can go and buy an established unit in the same suburb for half the cost or even less than 500 grand, less than in the intrinsic value, then you even do better. So don't get caught up thinking this is a good growth corridor or depreciation or all the rubbish they spruik. Because again, anyone pushing this product is getting kickbacks from the developer. So buyers, be very aware. Anyway, a bit of disclaimer, housekeeping. I mean, this content's general in nature, no personal advice or general advice at all. I'm a buyer's agent though. This is my story. This is my train of thoughts. If you want to build a large, even a modest portfolio of 5 to 6 properties or 10+ properties, I can help you source properties for under bank value, under replacement costs, under construction costs, so under the actual intrinsic value with a high cash flow of at least 5% gross yield and ideally between the 6 to 8%. In areas that will gentrify over time, so the likes of what happened to Surrey Hills, Redfern, where they got a lot of investment into those areas from the public sector, upgrading roads, light rails, public transport, selling off housing commission estates. That then re-gentrifies the area when a lot of private investors come in and buy up old sites, knock them down, redevelop the area to it is today of a nice, desirable yuppie area. So we look at those types of suburbs that are getting the infrastructure spend where there has been a lack of historically, and then hold them through their transition into a more desirable area and having a good balance of both capital growth and cash flow. You can't just chase growth because you get stuck with servicing at 1 or 2 if you've got a yield of less than 2%. On the other side of the coin, not going out to Broken Hill and buying a house for 100 grand that's got a 15-20% yield because you have next to no growth. You need a good balance of both. So we find this in within half an hour to 45 minutes of a metro market for units and large regional hubs for houses and blocks of units, and also blocks of units in the metro market. So never spend more than $500,000 per property, whether that is a unit, a villa, townhouse, house, and the same goes for a block of units. Our sweet spot is between that 250 to 350 mark. That is where you'll get a good solid asset that's established property that's gone through the test of time, that won't have major structural defects because it wasn't built by dodgy builders these days. It's half the intrinsic value, getting it for half the intrinsic value of replacing the asset. So if you're buying a property for 250, 300, you can't even build a property these days for really less than 500 grand. So you're automatically getting equity from day one. The banks have to value it higher, have a solid, strong cash flow, which will allow the bank to keep lending you more money against the asset to then leverage against it to buy your next one and keep growing. In that suburb, that will gentrify because then you'll really supercharge your growth where your suburb is transitioning from a less desirable to a more desirable area and having a good, solid cash flow and capital growth balance to allow you to build a solid residential foundation portfolio of 10 plus properties with a short period of time, 10 years. And you don't need a big income. With this strategy, with the Williams real estate strategy, we target the properties that are self-sufficient. So then it's not eating into your lifestyle, it's adding to your lifestyle. It's not dependent on your wage, so you can work a couple of days a week after a good 5-6 years worth of investing and enjoy the fruits of your labor and get back your time, because that is the main thing when it comes to property investment. It's not about the money and all that. It's about your time. How valuable is your time, getting your time back. Until next time, thanks for watching. See you then.